me ask you something that will change how you think about building wealth in 2026. If you had to put your entire life savings into just 5 stocks right now, stocks you would hold through whatever chaos the next few years might bring, which 5 would you choose? Most people cannot answer that question. They freeze. They second-guess themselves. They start listing companies they have heard about on television without any real conviction behind their choices. But I can answer it. And today, I am going to share exactly which 5 stocks I would buy if I were starting fresh in 2026, looking for businesses that can deliver exceptional growth while still meeting my standards for quality and durability. These are not speculative bets. These are not meme stocks or momentum plays. These are businesses I believe will be worth substantially more 5 and 10 years from now than they are today. Now, before you assume I am going to give you the same tired list of blue chip dividend payers, let me surprise you. The investment landscape has changed. The opportunities that exist today are different from what existed a decade ago. And while my principles remain the same, the specific businesses that best embody those principles have evolved. Some of what I am about to share might challenge your assumptions about what a value investor looks for. Let me take you back to 1972. I was 42 years old and I had just made what many people considered a foolish decision. I paid a premium price for a candy company called See's Candies. $25 million for a business earning about $4 million per year. That was over 6 times earnings at a time when I could buy perfectly good businesses for 3 or 4 times earnings. My partner, Charlie, thought I was overpaying. The sellers thought they had gotten the better end of the deal. Wall Street analysts who followed my moves were puzzled. Why would someone known for buying cheap stocks pay such a high multiple for a regional candy company? Here is what I understood that others missed. See's Candies had something that most businesses lack. They had pricing power. Every year they could raise prices and customers would keep buying because the product represented something emotional, something tied to memories and traditions and gift-giving occasions. The brand had earned a place in people's hearts that no competitor could easily dislodge. That $25 million investment has since generated over $2 billion in pre-tax earnings for us. $2 billion from $25 million. And the business required almost no additional capital investment along the way. The cash just flowed out year after year, available to reinvest in other opportunities. That experience transformed how I think about investing. I stopped looking exclusively for statistically cheap stocks and started looking for wonderful businesses at fair prices. I realized that a great business purchased at a reasonable valuation will dramatically outperform a mediocre business purchased at a bargain price. Quality compounds, mediocrity decays. The 5 stocks I am sharing today all possess qualities that remind me of See's Candies in 1972. They have durable competitive advantages. They have pricing power. They generate substantial free cash flow. They are run by capable and honest managers, and they have long runways for growth that will allow them to compound value for years to come. Here's how I am going to structure this. I will share each company along with my reasoning for why it belongs in a concentrated portfolio. I will explain the specific characteristics that make each business exceptional, and I will address the objections that skeptics might raise so you can make informed decisions for yourself. The first stock I would buy for 2026 is Apple. Now, I know some of you are thinking that Apple is obvious, that everyone already knows about Apple, that there cannot possibly be any insight left to share. But that reaction itself reveals why most investors underperform. They dismiss great businesses as too obvious and go searching for hidden gems that usually turn out to be fool's gold. Let me tell you what I see when I look at Apple that most people miss entirely. Apple is not a technology company. Apple is the most powerful consumer brand on earth that happens to use technology as its delivery mechanism. The distinction matters enormously. Technology companies face constant disruption. The hot product today becomes obsolete tomorrow. The market leader gets displaced by a startup with a better approach. This is why I avoided technology for most of my career. The competitive dynamics were too unstable, too unpredictable, but Apple has transcended those dynamics. They have built an ecosystem that locks in over 2 billion users worldwide. Once you own an iPhone, you buy AirPods because they work seamlessly together. You buy an Apple Watch because it integrates perfectly. You use iCloud because your photos and documents are already there. You subscribe to Apple Music and Apple Television because they are right there in your pocket. Each product reinforces every other product. Each service makes every other service more valuable. The switching costs are enormous. I have spoken with people who desperately wanted to try an Android phone but could not bring themselves to leave the Apple ecosystem. Their photos, their messages, their apps, their watch, their earbuds, everything was tied together in ways that made switching practically unthinkable. That is not technology advantage. That is brand and ecosystem advantage. And those advantages persist for decades. The financial characteristics are equally compelling. Apple generates over $100 billion in free cash flow annually. They return most of it to shareholders through dividends and buybacks. The share count has declined by over 35% in the past decade, meaning your ownership percentage increases every year, even if you never buy another share. People worry about iPhone saturation. They point out that smartphone penetration is already high in developed markets, but they miss the services growth story. Apple services revenue has grown from essentially nothing to over $85 billion annually. This is high-margin recurring revenue that grows even when hardware sales are flat. And services are still early in their growth trajectory as Apple expands into health, finance, entertainment, and categories we cannot yet predict. If I were building a portfolio from scratch today, Apple would be my largest position. Not because it will double next year, probably it will not, but because I cannot envision a scenario where Apple is worth less in 10 years than it is today. The combination of brand strength, ecosystem lock-in financial quality, and management excellence makes this one of the safest long-term investments I can identify. Let me share something else about Apple that most analysts overlook. The installed base keeps growing even as critics proclaim saturation. There are now over 2 billion active Apple devices worldwide. Each device represents a customer relationship that generates ongoing services revenue. Each device creates potential for additional product purchases. The installed base is not just a number. It is a compounding asset that grows more valuable every year. The health initiatives particularly excite me. The Apple Watch has become the most important health monitoring device in the world. It detects irregular heart rhythms. It tracks sleep patterns. It monitors blood oxygen levels. It can detect falls and automatically call emergency services. Over the coming decade, Apple will become a major force in healthcare. The data they collect, with user permission, will enable early detection of diseases that currently go undiagnosed. This is not just a business opportunity. It is a genuine contribution to human welfare. Privacy has become another competitive advantage. While other technology companies build business models around harvesting and selling user data, Apple has positioned itself as the defender of customer privacy. They process data on device rather than in the cloud. They give users control over what information they share in a world increasingly concerned about surveillance and data exploitation. This positioning attracts customers who might otherwise be skeptical of big technology companies. The second stock I would buy is American Express. This might surprise people who think of credit cards as a commodity business where everyone competes on rewards and interest rates. But American Express operates a fundamentally different business model that creates durable advantages. Most credit card companies make money primarily from interest charges on revolving balances. They want customers to carry debt and pay high interest rates. American Express makes money primarily from merchant fees on transactions. They want customers who spend heavily and pay their balances in full. This attracts a completely different customer base. Higher income, higher spending, more desirable for merchants. The American Express customer is worth more to a restaurant or hotel or airline than a typical credit card customer. They spend more per transaction. They visit more frequently. They are less price sensitive. This is why merchants willingly pay higher fees to accept American Express, even though they could insist on Visa or MasterCard at lower rates. The American Express customer is worth the premium. This creates a virtuous cycle that competitors cannot easily replicate. Premium customers attract merchants willing to pay premium fees. Premium merchant acceptance attracts more premium customers. The brand becomes associated with affluence and exclusivity, which further reinforces its appeal to both sides of the marketplace. I have owned American Express shares since the 1990s. The company has navigated multiple challenges over the decades: recessions, competitive threats, regulatory changes, the rise of fintech. Each time skeptics predicted doom. Each time the company adapted and emerged stronger. That resilience reflects the underlying strength of the business model. Let me tell you a story that illustrates why I love this company. Back in 1963, American Express faced a crisis that nearly destroyed it. A scandal involving salad oil tanks led to massive fraud losses. The stock collapsed. Analysts predicted bankruptcy, but I did my own research. I visited restaurants and shops. I watched how customers reacted when they pulled out their American Express cards. The prestige was still there. The brand still commanded respect. So I bought heavily while everyone else was selling. That investment turned out to be one of the best I ever made. What that experience taught me is that great brands can survive crises that would destroy lesser businesses. American Express has that kind of brand durability. Even when they stumble, even when they face challenges, the underlying customer loyalty and merchant acceptance persist. You cannot replicate decades of brand building with marketing spend alone. The growth opportunities remain substantial. International expansion is still early. Small business services are growing rapidly. Digital payment volumes continue rising as cash transactions decline globally, and the company's ability to raise merchant fees over time, even gradually, compounds into enormous value creation over decades. The younger generation is sometimes written off as unlikely American Express customers, but the data shows otherwise. Millennials and Gen Z are attracted to premium brands that signal success and aspiration. They want credit cards that provide status and experiences, not just rewards points. American Express is positioned perfectly to capture these customers as their incomes rise through their careers. The third stock I would buy is Coca-Cola. Now I can already hear the objections, Warren. Soda consumption is declining. Health-conscious consumers are avoiding sugary drinks. Coca-Cola is a relic of the past. Those objections miss the transformation Coca-Cola has undergone over the past decade. This is no longer just a soda company. This is a total beverage company that owns leading brands across virtually every drink category. They own water brands like Dasani and Smartwater. They own juice brands like Simply and Minute Maid. They own sports drinks, energy drinks, tea, coffee, and countless regional brands around the world. When consumers shift away from soda, they often shift to other beverages that Coca-Cola also owns. The company does not lose. It just redirects the customer to a different brand in its portfolio. This diversification dramatically reduces the risk that any single health trend can threaten the business. The distribution network is perhaps the most underappreciated asset. Coca-Cola products are available in more than 200 countries and territories. You can buy a Coke in the most remote villages in Africa, in gas stations across rural America, in vending machines throughout Asia. Building that distribution reach required decades of investment. Replicating it would be nearly impossible for any competitor. And here is something that gets me genuinely excited. In developing markets around the world, hundreds of millions of people are entering the middle class for the first time. One of the first things people do when they have disposable income is buy branded consumer products. Coca-Cola is often among the first brands they choose because it represents aspiration and modernity. The growth potential in emerging markets will drive volume expansion for decades. The dividend is another attraction. Coca-Cola has increased its dividend for over 60 consecutive years. Through recessions, wars, financial crises, pandemics, the dividend keeps growing. That consistency reflects the durability of the underlying business and the commitment of management to shareholder returns. I bought my first shares of Coca-Cola back in 1988. At the time, people thought I was overpaying. The stock had already risen substantially. The price-to-earnings ratio seemed stretched. But I understood something the critics missed. I understood the global growth potential. I understood the brand strength. I understood the economics of concentrate manufacturing. Since that initial purchase, Coca-Cola has returned over 20 times my original investment through a combination of price appreciation and dividends, and that return has come with almost no sleepless nights. I have never worried about Coca-Cola going bankrupt. I have never worried about some startup disrupting their business. I have simply collected dividends and watched the value compound year after year. The current yield provides meaningful income for investors who need cash flow from their portfolios. But the dividend growth rate is equally important. A dividend that grows at 6 or 7% annually doubles every decade or so. Over 20 or 30 years of ownership, the income stream from a position established today will grow to multiples of the initial yield. This is how dividend growth investing builds wealth, not from the starting yield, but from decades of compounding increases. The fourth stock I would buy is Moody's Corporation. This is one of the most exceptional businesses I have ever encountered, and yet most individual investors have never even heard of it. Moody's operates credit rating agencies that assess the creditworthiness of bonds and other debt instruments. When a corporation or government wants to borrow money by issuing bonds, they typically need ratings from agencies like Moody's without ratings. Many institutional investors cannot or will not buy the bonds. The ratings are essentially required for accessing debt markets. This creates an extraordinary business model. Moody's charges fees to provide opinions. They do not manufacture anything. They do not carry inventory. They do not require factories or equipment. The business is almost entirely human capital and brand reputation. This means margins are extremely high and capital requirements are minimal. But here is what makes it truly special. There are only 3 major credit rating agencies in the world: Moody's, Standard & Poor's, and Fitch. Regulatory requirements, institutional policies, and market conventions all reinforce the dominance of these 3. A new entrant cannot simply decide to compete. They would need decades to build the track record and reputation required to be taken seriously. This is perhaps the closest thing to a legal oligopoly that exists in financial services. The barriers to entry are essentially insurmountable, and demand for ratings grows automatically as global debt markets expand. Every new corporate bond, every municipal financing, every sovereign debt issuance requires ratings. Moody's captures fees on all of it. The company has also built a substantial analytics business, providing research, data, and risk assessment tools to financial institutions. This diversification reduces dependence on new debt issuance and provides recurring revenue streams. Both segments generate excellent returns on capital with minimal competitive pressure. When I look at Moody's, I see a business that will almost certainly be more valuable in 10 years than it is today. The competitive position is unassailable. The growth is tied to global capital markets expansion. The financial characteristics are superb. This is exactly the type of business I want to own for decades. Some people worry about conflicts of interest in the rating agency business. They point to the financial crisis when agencies gave high ratings to securities that later defaulted. These concerns have validity, but they have not fundamentally changed the industry structure. Regulation has increased oversight, but has not introduced new competitors. The oligopoly remains intact. The cyclicality of debt issuance is another concern. When interest rates rise or credit conditions tighten, new bond issuance declines. This affects Moody's revenue in the short term, but here's what I have observed over many cycles. Debt markets always come back. Companies always need to refinance maturing obligations. Governments always need to fund deficits. The long-term trend of global debt expansion is unmistakable, even if the path is bumpy. I also appreciate that Moody's does not require aggressive capital deployment to grow. They do not need to build factories or develop expensive new products. Their growth comes primarily from expanding their services, acquiring complementary businesses, and benefiting from the natural expansion of debt markets. This capital-light model means most earnings can return to shareholders rather than being consumed by the business. The fifth stock I would buy is Visa. Payments infrastructure represents one of the most attractive business models I have encountered in 7 decades of investing, and Visa sits at the center of global payments in a position that grows more dominant with each passing year. Every time you swipe a credit card or tap your phone to pay, Visa typically earns a small fee on that transaction. They do not take credit risk. They do not hold the debt. They simply operate the network that connects buyers, sellers, and financial institutions. It is a toll booth on global commerce. The numbers are staggering. Visa processes over $15 trillion in payment volume annually. Even a tiny fee on each transaction adds up to enormous revenue when the volume is that large. And the volume keeps growing as cash transactions decline and electronic payments expand globally. The network effects create insurmountable barriers to entry. Merchants accept Visa because consumers carry Visa cards. Consumers carry Visa cards because merchants accept them. Banks issue Visa cards because both merchants and consumers expect it. Each participant reinforces the others in a self-sustaining ecosystem. Someone attempting to build a competing network would face a chicken and egg problem. You need merchants and consumers and banks all at once, but none will join without the others. Visa solved this problem decades ago. Anyone trying to replicate it today would find it practically impossible. The growth runway extends for decades. Cash still represents a substantial portion of global transactions, especially in developing markets. As economies modernize and electronic payments expand, Visa captures a percentage of that shift. They do not need to do anything extraordinary. They simply need commerce to continue shifting from physical cash to electronic payments, a trend that shows no signs of reversing. The margin structure is exceptional. Visa converts roughly 50 cents of every revenue dollar into operating profit. They require minimal capital investment to grow. The excess cash flows back to shareholders through dividends and buybacks. This is a compounding machine that gets more powerful with each passing year. What many investors fail to appreciate is the operating leverage in Visa's business model. The infrastructure is already built. The network is already established. Each additional transaction that flows through the network generates incremental revenue with minimal incremental cost. As transaction volumes grow, margins have potential to expand even further. The competitive threats that people worry about have largely failed to materialize. Cryptocurrency was supposed to disrupt traditional payment networks. It has not. Mobile payment apps were supposed to bypass card networks. Instead, most of them rely on card networks for funding and settlement. The alternatives that have gained traction tend to complement rather than replace traditional payment infrastructure. I also find comfort in the recurring nature of payment flows. People buy groceries every week. They pay utility bills every month. They make countless small purchases that add up to enormous transaction volumes. This is not discretionary spending that disappears in recessions. Even during economic downturns, people continue making payments for necessities. The stability of transaction volumes provides remarkable consistency to Visa's business. Now let me step back and explain the common characteristics that unite these 5 companies, because understanding why I chose them is more valuable than simply knowing what I chose. First, all 5 businesses have genuine economic moats. They have something that protects them from competition, whether that is ecosystem lock-in, brand strength, regulatory advantages, or network effects without a moat. Any business earning high returns will eventually see those returns competed away. Moats allow high returns to persist and compound over time. Second, all 5 businesses generate substantial free cash flow relative to the capital they require. This is crucial because it means the companies can return cash to shareholders, reinvest in growth opportunities, or make acquisitions without constantly needing to raise external capital. Businesses that consume cash rather than generate it make poor long-term investments, regardless of how exciting their prospects might seem. Third, all 5 businesses benefit from secular growth trends that will persist for years or decades. Apple benefits from digital transformation and services growth. American Express benefits from rising affluence and declining cash usage. Coca-Cola benefits from emerging market consumption growth. Moody's benefits from expanding global debt markets. Visa benefits from the ongoing shift from cash to electronic payments. These are not cyclical trends that reverse. They are structural shifts that compound over time. Fourth, all 5 businesses are run by capable management teams with track records of intelligent capital allocation over long holding periods. What management does with the cash? A business generates matters enormously. Do they make sensible acquisitions or overpay for empire building? Do they return capital efficiently or waste it on vanity projects? Do they focus on long-term value creation or chase quarterly earnings? The management teams at these companies have demonstrated good judgment repeatedly. Fifth, all 5 businesses are available at reasonable valuations relative to their quality and growth prospects. I would not buy any of these stocks at any price. Valuation always matters, but at current prices, I believe the expected returns are attractive for patient investors with multi-year time horizons. Let me elaborate on what I mean by reasonable valuations. I am not looking for stocks trading at 8 or 10 times earnings. Those valuations usually reflect problems with the underlying business. What I am looking for is quality that justifies premium pricing combined with growth that will make current prices look cheap in retrospect. Think about it this way. If a business can grow earnings at 12% annually for a decade, it will have roughly 3 times the earnings power at the end of that period. A stock that looks expensive at 25 times current earnings will look quite reasonable at 8 times those future earnings. The trick is identifying businesses with the durability and competitive position to actually deliver that growth. All 5 of these companies have track records of consistent execution over decades. They have management teams that understand capital allocation. They have business models that generate growth without requiring aggressive risk-taking. These characteristics give me confidence that the growth assumptions embedded in current valuations are achievable. I want to be clear about something else. These stocks will not go up in a straight line. There will be quarters when earnings disappoint. There will be periods when the broader market declines and takes these stocks down with it. There will be moments when you question whether you made the right decision. Those moments are the test. That is when most investors fail. They buy during euphoria and sell during panic, ensuring poor results. The investors who build real wealth do the opposite. They maintain conviction through volatility. They recognize that short-term price movements reflect psychology more than fundamentals. They stay focused on the long-term trajectory of the underlying businesses. Let me address some objections because I know skeptics will raise them. Some people will say these stocks are too expensive by traditional valuation metrics. Price-to-earnings ratios are above historical averages for all 5. My response is that quality deserves a premium. A business that will compound at 15% annually for a decade is worth far more than a business that will compound at 5%. Even if both have the same current earnings, the mistake most investors make is applying the same valuation framework to very different quality businesses. Some people will say these are obvious choices that everyone already owns. My response is that obvious is not the same as wrong. The best investments are often hiding in plain sight, while everyone searches for obscure, undiscovered opportunities. I would rather own an obvious business with predictable, excellent results than an obscure business with uncertain prospects. Some people will say I should diversify more broadly than just 5 stocks. My response is that diversification protects against ignorance. If you do not know what you are doing, then yes, you should own dozens or hundreds of stocks through index funds. But if you truly understand a business deeply, concentration builds wealth faster than diversification. I would rather own 5 businesses I understand completely than 50 businesses I know nothing about. Some people will say, I am too old to understand modern technology companies. My response is that I am not evaluating these companies as technology investments. I'm evaluating them as businesses with competitive advantages, predictable cash flows, and capable management. Those criteria do not require technical expertise. They require business judgment developed over decades of experience. Let me share how I would actually implement this if I were starting fresh with a meaningful sum of money. I would make Apple my largest position, perhaps 30% of the portfolio. This is the highest quality business with the most predictable trajectory. The combination of ecosystem strength, services growth, and capital return makes this the foundation I would build around. I would allocate 20% each to Visa and Moody's. Both are exceptional businesses with similar characteristics: high margins, low capital requirements, durable moats, and long growth runways. Having exposure to both payments and capital markets provides some diversification while maintaining concentration and quality. I would allocate 15% each to American Express and Coca-Cola. Both are excellent businesses with slightly lower growth profiles, but exceptional durability and shareholder return programs. They provide stability and dividend income while still offering appreciation potential. I would not try to time entries perfectly. Waiting for the perfect price often means never buying at all. I would build positions gradually over months rather than investing everything at once. This dollar-cost averaging approach reduces the impact of short-term volatility and removes the psychological pressure of trying to pick exact bottoms. I would commit to holding these positions for years, ideally decades. Short-term price movements would not concern me. Quarterly earnings misses would not prompt selling. My focus would be on whether the fundamental competitive advantages remained intact. As long as the moats persist, I would hold through any volatility. Some of you watching this are thinking about your retirement portfolios, about money you need to last for decades. These 5 businesses are exactly what I would want to own in that situation. They are durable enough to survive whatever economic or political challenges arise. They are growing enough to outpace inflation and build real wealth. They are managed conservatively enough that catastrophic outcomes are unlikely. Others are thinking about building wealth over a career compounding savings over 20 or 30 years. Again, these businesses fit perfectly. They will not make you rich overnight. They will not double next month. But they will almost certainly be worth substantially more in a decade than they are today. Patient ownership of quality compounds into extraordinary results over long time periods. The mistake most investors make is chasing what is hot instead of owning what is great. They buy whatever stock has been going up lately, whatever name is dominating headlines, whatever their neighbor mentioned at a barbecue. That approach produces mediocre results at best and devastating losses at worst. The approach I am describing is different. It requires patience that most people lack. It requires conviction to hold through inevitable downturns. It requires the discipline to ignore noise and focus on fundamentals. But for those who can execute it, the results speak for themselves. I have been investing for over 70 years. I have seen bull markets and bear markets, booms and busts, panics and euphoria. Through all of it, one pattern has held consistently. Great businesses purchased at reasonable prices and held for long periods generate wealth that speculation and trading cannot match. These 5 stocks represent exactly that opportunity: quality businesses with durable advantages available at prices that offer attractive long-term returns. Not exciting, perhaps, not the subject of breathless media coverage, but exactly the kind of investments that actually build lasting wealth. The choice now is yours. You can chase whatever is hot in the moment, whatever promises quick riches, whatever everyone else seems to be buying. Or you can own pieces of exceptional businesses and let time and compounding work in your favor. I know which approach has worked for me. I know which approach I would recommend to my own family, and I know which approach I believe will serve you best over the decades ahead.